story, and we'll get you updates as we go along. Nandan Chakraborty is now joining us. He's a head of strategy at DAM Capital, and Nandan really needs no introduction. He's been closely sort of tracking markets, commenting on macro markets. I think at least 20 years more. I've been reading, or Nandan has been writing for 20 years now. Nandan, good to have you back on the program, on the channel. It's been a while, and I hope this is the first of many. And we get you at a pretty opportune time, because we'd like to ask you, how are things looking? We've got a bit of a pullback. Actually, it's not a bit of a pullback. Let's call it what it is. It is a significant pullback, right? I mean, in a day, 4% kind of pullbacks on indices, mid-cap and small caps, is not small. But what from here, in your opinion, for that part of the market as you see it?
The strategy report that you just released about 8 days back answers 6 questions that everybody is asking. So let me give you a little bit of perspective on these 6 questions and what are our conclusions. After that, we can go into detail in any of them. So the first thing, if you look at the cover of the strategy report, basically it shows a tiger with its jaws open and a tiger bird, which is basically the Indian tree pie, which is trying to pick its teeth and get out morsels. This is a synergistic relationship. Both the animals have the same skin color, and this has been for thousands of millennia of years. This has been going on. The idea is that when the tiger's jaw is open, which means it's a bull market, it can close any time. So you have to be very selective in what you purchase. So that's the overall idea. See, second thing is whether the question that people are asking are we in a bubble already, or is it just a bull market? So first thing I'd like to say is essentially liquidity drives the phases of the markets. And when I was in INAM, I think I did a lot of strategy reports on the various phases of the market on a qualitative basis. So liquidity is not the same as earnings growth. Earnings growth, valuations, relative valuations, all three play a part in liquidity coming and going. And that's how the markets are made. So you can have very lukewarm earnings growth, but a low P, which then starts going up in expectation that results in a bull market. So there are 3 things which are important. So in terms of a bubble or a bull market now, what we've done in the strategy report is I've basically taken the last 20 years, the various bubbles, and said that, and basically compared the valuations and so on. So today you are among, or maybe the most expensive market in the world among all the major markets. There's no question about it. However, in terms of the premium to the US markets, and in terms of the premium to emerging markets, which is largely China and the others, and with respect to your own 5-year history, compared to the earlier bubbles, you are not in an alert zone. So that's the first thing. Number 2 is there is no great, in terms of the advanced decline line, 52 new 52-week highs, etc., etc. There's nothing which is alarming as of now. Usually there is a narrowing of the rally. So if you look day to day, most of the days, once in 3 days, the PSU bank sector goes up. Otherwise, it's almost every day a new sector is going up. So there is no narrowing of the rally as of now, which is a usual, test of a bubble forming. So the first is that we are not in a bubble, we are in a bull market. Second is now where do we go from here? So basically there are 4 indicators which I think we need to track. Number 1 is FII flows. So FII flows depends on 2 things. What happens in the US in terms of Fed rate and US recovery and all that. And second is China. The stimulus that they started talking about in January, and again they started talking about last month, whether there is any steam to it or not, and therefore will some monies outflow to China instead of India. It can happen. But very unlikely as of now. We've got serious problems. Third is there any slowdown in SIPs, which have been the backbone of the Indian domestic markets? Third, is the El Nino. So there is El Nino, there is SOI and so on. The basically different indicators have now come up from the Australian Met, whether there'll be an El Nino this month or not. Fourth is the results of the 4 major state elections out of the 5. So these are the 4 indicators I think that we must look for in terms of the markets. The third is where are the earnings alerts. So if you look at the results so far in terms of downgrades as well as the results themselves, there are 3 areas where the results have not been very good. chemicals, IT, and capital goods. Capital goods, of course, the order books are crazy. So these formed around about 15% of the total market weightage of NSE 200. Second is the El Nino. That's an alert. So it will affect a vast swath of different these things. It is a large percentage. It comes to 28% of the NSE 200, but obviously it will not affect all of them dramatically. So there's auto, cement, there's that, all the normal these things, NBFCs, etc. So that is the second part. The third question that people ask is what is happening to the mid-cap rally. So we released this report around about 8 days back. Essentially what we are saying is that mid-caps go up either when there's a GDP surprise, which is not the case now, or when the premium to the NSE 200 or the Nifty is it's at a huge discount. Today, the price to book, normal discount to the Nifty is minus 8%, you're already at 10% premium. So at 18% premium to what it should be. So mid caps are obviously, and the reason for this huge overvaluation of mid caps has been basically the way our markets are structured. So we have $270 billion of mutual fund money. We have $270 billion, which is the same amount in retail, which includes PMS, which has become a huge amount, which is $67 billion. So what happens? The large funds, FIIs, insurance, etc., normally don't put money in small and mid caps. But the amount of retail and PMS has basically shot up. So that is the reason for this mid cap rally. Yeah.
Nandan, if you could allow me to come in over there, and that's exactly the question that I've been having, on my mind since morning, watching the mid cap correction. The collective wisdom that seems to be coming out right now is that the market is okay. Mid caps have rallied a lot. So as long as maybe you alter positions a bit, unload from mid caps, invest more in large caps, you'll be fine. Do you agree with this near consensus that seems to be emerging?
See, it's very difficult to get in and out of markets for a retail investor. Mid caps and small caps by itself are basically quite illiquid. You can't have a strategy of getting in and out wherever you think it's right. So mid caps may not correct, may just go on and do a time correction. What you have to be concerned about is which type of mid caps are you in? Are you in the price to order book mid caps, which are huge, which sectors we know, or you're not? If you look at a typical mutual fund which has mid cap portfolio, say, if you take the top 20, very few are in these frightening stocks. Also remember, a mid cap, when it gets overvalued, it's not that the earnings growth is bad. It is just that your expectations is far more. So just like in 2000 when you had Infosys earnings growth was not bad. It was just that the price expectations were far, far more. So similarly for mid caps, which are basically order book driven industries, these are revenues which are over a very long time. So it will be executed, a few percentage each year. And then
so would you agree?
Price.
So are you saying that what's happening right now is that we don't have a quality issue when it comes to mid caps, as we've seen in some past cycles, where just the quality of the kind of stocks that was going up was questionable. So we're not in that zone, but it's just that the market has run ahead of itself, way ahead, purely in terms of earnings expectations. Is that the problem? And can we safely say that?
The first one, yeah. So the first one, if you see the institutional portfolios of mid caps and you take the top 20 stocks that they own, there are very few stocks which are, dangerous stocks, which are overpriced stocks. The problem is in the individual investor, maybe PMS. So it really depends on stock to stock. The institutions are not in that much of a problem. As a matter of fact, many of the institutional funds have been quite hesitant to put in money. Inflows keep coming, so they have to put. But a lot of them were in cash in the last 1 month. So I think that is the issue. It is a type of stock that you are in mid caps.
Nandan, so coming in on that point, the type of stocks which have gone up in the last 6 months or in the last 1 year have been the aerospace, the defense, the capital goods, the industrial, the power, renewable. Those are the themes which are largely the PSU stocks which the street, the retail investors have latched on to, even by way of direct investments. What would be the advice on these group of stocks?
So do a sanity check on what you own. It's as simple as that, yeah.
But in your assessment, do you think No, but you did speak about, in some cases, these are long gestation orders. There could be volatility in the order inflows for companies, say in the defense, etc., or even in railway, for instance. Do you think broadly this category has run ahead of itself?
Yeah. So the margins are not very high, so you don't have too much of a buffer. And these are fairly long gestation. So it will take a long time to unfold. So it is not that these stocks are, bad quality. It is just that the expectations are far more.
Hi Nandan, good afternoon. Nigel on this side. Good to have you on the show. And then, few stocks, though, I'm going through a report, the DAM Capital India strategy, and some potential doublers is what you'll have identified. Run us through a few of them.
So, see, essentially, if we are saying that the mid-cap rally is sort of overdone and there could be a time correction and so on, so where does the safety lie? So the idea is to give those, few stocks, 11 stocks is what we've given, or cricket team or football team, whatever you call it, where the EBITDA can double in the next 3 years. So you have a doubling of the EBITDA, which is roughly about 25%, 26% CAGR, where the PE, there is little chance of PE derating, and where the target price upside is not negative. So if you get these, you get a clutch of stocks which are still, in the sanity list.
So are the sanitary stocks in the sanity list, Nandan? You guessed my second question, right? Basically, let's talk real estate, let's talk home builders, home improvement. Sanitary is part of that. But does sanitary have sanity?
So the stocks in the realty space are fairly valued. So they are not very high, neither are they too low. They are not really order book related stocks. The problem has come in the order book related stocks.
So price to order book is what you called it, Nandan, right? That is railways, defense, what else?
Yeah, all that.
Even so, these two
Space.
primarily.
Space research. There's so many of those there. Capital goods. So, these what will happen is basically the danger areas now are basically two areas. One is rural and the other is capex outlay. So,
By the way,
sorry?
Yeah, sorry, go on. Please finish.
Yeah, so as far as the rural scene is concerned, El Nino on the one hand is a Damocles sword over us. On the other hand, the government is going to spend a lot of money pre-election. And the other area is capex outlook, where the government is basically front-ended all its capex, and which is the hope is that will flow into the private sector. But the private sector basically has been very weak in the results, but the order books are very strong.
Yeah, no, absolutely. Got that. Nandan, we'll leave it there. Good chat today. Appreciate you joining in. And as I said, hope you come back sooner than this one. Thank you. Well, let's just take a quick look at what the market is doing. Not very much. 8 points lower. Broader market still under pressure with a 4% cut in the small cap index and the mid cap index, which is down 3% or so. We are back. Dinshaw Irani of Helios Capital India on the other side. Stay tuned.